So Concentrix just dropped their earnings, and honestly, on the surface, they looked fine, just fine. But then the stock absolutely took off. So what's going on here? In this quick breakdown, we're going to dig into the numbers, but more importantly, the story, to figure out why Wall Street is suddenly so excited about this company and what it means for the future. All right, let's kick things off with the headline numbers. Take a look. Non-GAAP EPS, so that's the adjusted earnings, came in at $2.95, just 4 cents ahead of what analysts were looking for. And revenue barely squeaked by, beating by just a little bit. I mean, in the grand scheme of things, this is okay. It's a solid hit for sure, but it's not a home run. Definitely not the kind of report that usually makes a stock go wild. And yet, look what happened. The market treated it like a grand slam. The stock shot up over 5.5%. So what gives, right? Why this massive reaction to a pretty minor beat? Well, the answer isn't in the raw numbers. It's in the story that management started weaving during their call. Yeah, to really get why this rally happened, we have to look past the spreadsheet and listen to what was said on the earnings call. Because really, the numbers were just the setup. It was the narrative that really got investors paying attention. And this right here, this is probably the single most important quote from the entire call. CEO Chris Caldwell said, "We are proving that AI is a tailwind for our business." Now, you gotta understand, for years, the biggest dark cloud hanging over Concentrix was this fear that AI was gonna just wipe them out, make their whole business model obsolete. And with this one sentence, management just grabbed that fear and completely flipped the script. They're not scared of AI. They're embracing it. And look, it wasn't just talk. They laid out a really clear 4-part plan to back it up. First, they're shifting away from the simple stuff to more complex, higher-value services. Second, they're going deeper with the clients they already have, getting a bigger piece of the pie. Third, they're using their own technology, their own IP, like their AI platform. And finally, they're tightening their belts internally to free up cash to invest in all this growth. It's a solid, disciplined game plan. Okay, so that all sounds great, right? A solid strategy. But you know how it is. Wall Street always wants to see the numbers. So the big question is, how does this whole AI-powered plan actually translate into their financial forecast for 2026? And here it is. This is the official guidance they put out. You can see they're targeting revenue right around that $10 billion mark with pretty solid earnings. But you know what? The most important detail here isn't even the headline numbers. It's what they said about their operating margins. They basically signaled that the big, expensive integration costs from their Webhelp acquisition are finally fading away. And that should mean much healthier profitability in the back half of the year. Okay, so let's recap. We've got a minor beat on the numbers, a huge news story around AI, and a pretty decent forecast. Now, let's step back and look at this through an investor's eyes to really understand the psychology of why this stock popped. You absolutely have to see where this stock was coming from to get it. I mean, look at this chart. This stock was completely left for dead. It was down big while the S&P 500 was ripping higher. What does that tell you? It tells you that expectations were rock bottom. I mean, in the gutter. The market was basically pricing this thing for total disaster. So you have to imagine investors were coming into this earnings call with a laundry list of worries. They were asking, are their profit margins ever going to recover after that big acquisition? Is their debt getting out of control? Can they actually pull off the cost cuts they promised? And of course, what's with that scary-looking gap loss? The thing is, this earnings report, while not mind-blowing, was just good enough. It did just enough to calm all of those specific fears. And yeah, let's talk about that giant loss for a second. A nearly $10 per share loss looks absolutely terrifying on paper, right? But it's really important to understand that this was basically just an accounting thing. It's what's called a non-cash goodwill impairment, which was actually triggered by the stock's low price. So think of it less like they're bleeding cash and more like they had to make a big entry in their accounting ledger. It doesn't reflect their actual ability to generate cash from the business. All right, so let's put all the pieces together. What's the bottom line here? Where does the stock go now? It's time for the next call where we lay out our take on what to expect. So we're giving this one an outperform rating. And just so we're all on the same page, when we say outperform, we just mean we think the stock has a really solid chance of doing better than the overall market, the S&P 500, over the next 6 to 12 months. So, yep, our official rating is outperform. We just think the setup here is too compelling to ignore. You had expectations at an all-time low, the main business is starting to look stable, and now they have this new AI story that gives them a clear path to growth. Our whole case for this really boils down to three things you need to watch. First, we're betting that their profit margins are going to get better as all those one-time integration costs finally disappear. Second, as they start delivering on their promises, we think the market will reward them with a higher valuation, what we call a re-rating. But the real game changer, the number one catalyst, is that AI story. If they can keep showing the world that AI is helping them, not hurting them, then this stock has a lot more room to climb. That is the story to watch. And as always, remember, this is not financial advice.